Every few decades, an industry places a bet so large, so aggressive, that it reshapes the entire economy around it. Railroads in the 1800s, telecoms in the 1990s. Today, it's happening again, and the scale is almost impossible to comprehend. 5 companies: Microsoft, Amazon, Alphabet, Meta, Oracle. In just 3 years, they have collectively spent close to $1 trillion on a single technology: artificial intelligence. But here's what almost nobody is talking about. While they're spending faster than any company in history ever has, their own cash reserves are quietly draining away. Some of them are already in the red. And to keep the machine running, they're doing something these companies have almost never had to do before. They're borrowing heavily. This is the story of the biggest gamble in corporate history, told entirely through the numbers. It starts quietly. In early 2023, these are just normal tech companies spending normal tech company money. Amazon leads, as it usually does, building warehouses and cloud servers. Nobody outside the industry is paying much attention yet. Then 2024 arrives, and the numbers stop looking like a business plan and start looking like a war effort. Microsoft's quarterly spending jumps by nearly 40% in a single year. Amazon crosses $26 billion in a single quarter, more than 2.5 times what it was investing just 18 months earlier. And then there's Oracle. For years, the quiet, overlooked player in this race. In a single quarter, Oracle's spending jumps by more than half. As the company signs the largest cloud computing contracts in its history, deals so large that over half of its entire order backlog would later be traced back to a single customer: OpenAI. By the first quarter of 2026, Amazon alone is spending $43 billion in 3 months. Combined, these 5 companies have now guided a staggering $725 billion in spending for this single year alone, up 77% from the year before. Even Google's own CEO, Sundar Pichai, has publicly acknowledged there's an element of irrationality in the current pace of investment across the industry. $943.6 billion across a 4-year window, including the 2026 forecast. That's more than the annual economic output of Switzerland. And this is only half of the story. Because while these companies are spending money faster than ever before, some of them are already running out of it. Free cash flow is the money a company has left over after paying for everything it needs to run the business. It's the number that tells you how much can this company afford to lose before it's in real trouble. Here's the thing about this story. It's not happening to all 5 companies at the same time. It's a domino line, and some dominoes have already fallen. Oracle fell first. Its free cash flow isn't just shrinking, it's gone negative. Over the last 12 months, $21.8 billion negative. Oracle is now spending more cash than its entire business brings in. Amazon is next, and it's happening right now. In 2024, Amazon generated $38 billion in free cash flow over the trailing 12 months. By 2025, that had collapsed to just $11 billion. And over the 12 months, ending in the first quarter of 2026, it went negative $17 billion in the red. Amazon's own regulatory filing put it bluntly: the company may need to raise both equity and debt to keep funding its build-out. Alphabet hasn't crossed the line yet, but the fall is the steepest of all: $73 billion in free cash flow in 2025, projected to collapse by 90% to just $8 billion in 2026. Analysts expect Alphabet to cross into negative territory sometime in early 2027. Meta's free cash flow is already down nearly 15% and expected to keep falling as Meta's own spending guidance for this year alone climbs toward $135 billion. Microsoft is the outlier. Its free cash flow actually jumped to over $47 billion this past quarter. But even Microsoft isn't immune. Analysts project it will be the last domino to fall sometime around 2028. One has already fallen. One is falling right now. 3 more are on the clock. Which raises an obvious question. If the money isn't coming from their own profits anymore, Where is it coming from? The answer is borrowed money and freshly printed shares. Between 2020 and 2024, these 5 companies issued an average of $28 billion in bonds per year, a modest, unremarkable number for companies this size. In 2025 alone, that number exploded to $121 billion, more than 4 times the average. And in 2026, analysts expect it to climb even higher, potentially past $500 billion in a single year. Look at Alphabet. Its long-term debt quadrupled in a single year, from under $11 billion to over $46 billion. Then, in February 2026, Alphabet did something no technology company had done in decades. It issued a bond that matures in 100 years. A company betting on artificial intelligence is now borrowing money it won't have to pay back until the 22nd century. And when bonds weren't enough, Alphabet went further still. In June 2026, it sold $84.75 billion of new stock, plus another $10 billion from a private placement with Warren Buffett's Berkshire Hathaway. A company that had spent 2 decades as one of the world's great cash machines was now diluting its own shareholders to keep the servers running. The stock dropped 6% in the weeks that followed. But the company analysts are watching most closely is Oracle. In fiscal year 2026, Oracle raised $43 billion in debt financing alone. In February, within days of announcing its funding plans, the company raised $30 billion through bonds and preferred stock. Analysts estimate that over half of Oracle's massive contract backlog comes from a single customer, OpenAI, a company that, itself, has never turned a profit. There's one exception in this entire story: Microsoft. Alone among the 5, it has not tapped the bond markets in this cycle. For now, it's still funding its build-out the old-fashioned way from its own cash. The question is how long that lasts. And there's a risk hiding beneath the surface. Moody's has found that hyperscaler lease commitments, data center leases signed, but not yet reflected on the balance sheet, already total around $662 billion. That's larger than these 5 companies' entire combined on-the-books debt. This is no longer being paid for with profits. It's being paid for with borrowed time, and increasingly, with borrowed money. 3 trends, all moving at the same time. Spending going up, cash reserves falling one company at a time, debt and new stock piling up faster than ever before. History has seen this pattern before, in railroads, in telecoms, in fiber optic cables during the dot-com era. Sometimes the bet pays off and the technology changes the world. Sometimes it doesn't. Either way, the numbers are the numbers, and right now, they're telling a story that's impossible to ignore. If you want to keep watching this story unfold, quarter by quarter, hit subscribe because next quarter's numbers are coming, whether the bet pays off or not.